watching Businessworld Live. I'm Danie, Laurel.
And I'm Delos Santos. Here are the biggest stories to kickstart this trading day, Monday. Metro Manila is entering the new normal. The capital, together with 38 other areas in the country, will be placed under Alert Level 1 beginning March 1st.
With that easing to the most relaxed classification, the Trade Department says about 500,000 jobs will be added to the labor market.
Inflation is expected to have accelerated in February following Russia's invasion of Ukraine. Analysts point to the surge in global oil prices as one of the main drivers of faster CPI for the month.
And with the ongoing conflict between Russia and Ukraine, shares are seen to drop further this week. We begin our broadcast with Metro Manila entering the so-called new normal.
This as the government placed NCR and many other places in the country under Alert Level 1 from March 1st until March 15. Now, under the lowest alert level, interzonal and interzonal travel are allowed regardless of age and comorbidities. Establishments, workplaces, and other activities can also operate at full capacity. Face-to-face classes in basic education will also be allowed, but this will still be subject to the approval of the president. However, take note that wearing of face masks is still required at all times, except when eating and participating in sports where physical distancing can be maintained. Now, aside from Metro Manila, other areas placed under Alert Level 1 include Abra, Apayao, Baguio, Kalinga, Dagupan, Ilocos Norte, Ilocos Sur, La Union, and Pangasinan.
The same goes for Batanes, Cagayan, Isabela, including the city of Santiago, Quirino, Angeles City, Aurora, Bataan, Bulacan, Olongapo City, Pampanga, and Tarlac. In the Visayas, Aklan, Bacolod City, Capiz, Guimaras, Siquijor, and Biliran have also been placed under Alert Level 1. Parts of Mindanao will also be under Alert Level 1. That's starting tomorrow. These are Zamboanga City, Cagayan de Oro, Camiguin, and Davao City. What will the impact of that easing to Alert Level 1 on the job market be? Well, the Trade Department expects that downgrade to the loosest classification to result in the eventual creation of about 500,000 jobs. Trade Secretary Mon Lopez says businesses can expect fewer restrictions on operating capacity, as well as the removal of physical barriers and work from home becoming now optional. Lopez says the country is now close to recovering jobs that were lost during the pandemic. He also says that around 800,000 jobs are expected to be created nationwide. That's once remaining restrictions are lifted.
Analysts say inflation likely accelerated this month due to the spike in global oil and commodity prices following Russia's invasion of Ukraine. The median estimate of 15 analysts in a Businessworld poll stands at 3.3% for February. That's faster than the 3% inflation recorded in January. This estimate is well within the BSP's 2 to 4% target and is lower than the 4.2% inflation recorded a year ago. The PSA will release the February inflation data on Friday, that's March 4. Like most analysts, our guess is forecasting inflation to have quickened a touch in February as tensions in Eastern Europe push up prices. To discuss that and more, we have on the show RCBC Chief Economist Mike Ricafort. Good morning, Sir Mike. Thank you for joining us today.
Hi, good morning, Jess and Danie. Thank you so much for having me.
All right, sir, most analysts are already forecasting faster inflation here for February, but we're just at the beginning of that brewing tension in Ukraine. Should this show no signs of abating anytime soon, do you see this driving up prices even more, and up to what level do you expect that to be happening and when?
Well, hopefully, Jess, we're still seeing normalization of the inflation base in the sense that we came from a higher base a year ago. So the year-on-year inflation would hopefully be maintained at the 3% levels. And, well, of course, the immediate impact of the geopolitical risks involving Russia and Ukraine would be the increase in global oil prices. As of this morning, we have seen again some upticks in global oil price. When to put things in perspective from the highs that we have seen last Thursday when they reach the benchmarks reach above $100, they're still well, at least they're still down by about somewhere between $3 to $5 based on the different oil benchmarks. The Brent oil, however, is back to a little over $100 per barrel. So definitely that would lead to some increase again in local fuel pump prices. And there are also other commodities, the prices of which also went up, especially those coming from both Russia and Ukraine. I'm talking about the likes of wheat, soybeans, and other grains. And of course, other than those commodities, we also have the likes of metals from Russia. And we all know that Russia also exports a lot of other commodities. So, of course, the sanctions and the various sanctions that not only on trade but also on the payment systems could potentially disrupt and reduce global trade and economic recovery prospects. And of course, the higher prices would definitely be passed on, especially if those that are imported by the country, like oil, wheat, soybeans. So among others, and some metals also. So that would lead to some other affected goods and services. There may be some uptick in prices. So definitely inflation would also pick up at the latter end of the 3% levels. So hopefully it won't reach 4% year on year, because of course we have to consider the fact that the ability of, say, businesses to pass on the prices is still somewhat limited by the fact that demand cost conditions coming from lockdowns and of course the pandemic is still the ongoing pandemic. So the ability to pass on may be limited. So that could mean margin compression, of course, by some of these producers and manufacturers and those who import these commodities. So yeah, that would be the impact.
Sir,
But hopefully, yeah, go ahead, Dan.
Yes, sir. I wanted to interrupt you, sorry, because you mentioned, not just oil, diba? We've always been talking about the oil story, but now we're talking about commodities. To what extent are we a trade partner of Ukraine, of Russia, or are we actually isolated from this issue? There are, in fact, analysts that are saying that we might even benefit when it comes to the mining sector because we might be able to export more nickel or other commodities now that there are sanctions there.
Actually, Danie, well, the amount of trade of the country with Russia and with Ukraine may be relatively smaller in terms of volume compared to the major trading partners. Yes, yeah, there may be some pockets of opportunities, like for instance, for nickel, considering that the Philippines is also a major exporter in the region, and that would benefit us also, because some of the sourcing, in view of the sanctions, in view of for both trade and the payments and other transactions, so the country may benefit from it, because definitely other countries around the world would look for other alternative suppliers other than Russia. So hopefully the Philippines could also benefit from that. But of course, it's still, we have yet to see, since all of these are still fresh, or these new sets of sanctions being announced. So let's see. But hopefully, there would be already some channels for diplomacy soon, as Ukraine already agreed for diplomatic talks with Russia. Let's see. Hopefully, there would be some resolution to this, and hopefully there would be a better path to peace rather than war that could create. Of course, the world already encountered supply side disruptions since the pandemic, and we don't want this to add to that. No? And we all know, given the pre-existing supply side disruptions, they have already been inflationary in the sense. So we don't want that to add to the supply on the supply side concerns.
Exactly the point there, Sir Mike. Like what you mentioned, supply side pressures here adding up to inflation worries here. But another concern, of course, would have to be our local unit here. Also steering higher inflation is a weakening of the peso. And as it is, of course, if we have to purchase more expensive oil, that would require more foreign exchange. What's the worst that could happen here for the local unit?
Well, so far, Jess, at least since the start of the year, the dollar peso has been capped at 51.50. So it has been relatively stable. Even as of this morning, it was little change. Maybe it's doing around 51.39 from Friday's 51.34. So despite all the development so far, there has been some semblance of stability at the local currency, and we have gotten pronouncements beforehand for the past couple of days and weeks that there would be some smoothening, uh, well, at least moves to smoothen the volatility in the exchange rate. So definitely that has helped in at least providing some form of order, stability in the local currency market, so to speak. And at the same time, we have to also acknowledge the fact that, uh, well, okay, there may be some increase on the imports volume, some widening of the trade deficit, but the structural inflows, if you look at it on an annual basis, for instance, OFW remittances every year, that's at least $35 billion, and BPO revenues close to $30 billion. And alongside other inflows, like you have at least the foreign tourism already started since February 10. So hopefully that would be we would see some gradual improvement to that. Some what would be remaining POGO revenues, some FDIs. FDIs have been near record highs recently. It could even rival the previous record highs, and you have to offset that, add everything, all those inflows minus the trade deficit of the country, which runs at least 40 billion per year. So we have more than enough inflows, and at the same time, the gross international reserves of the country it's still near record highs at around $108 billion, and that's equivalent to at least 10 months worth of imports. That's at least 3 times more than the international threshold of 3 to 4 months. So hopefully
Sir,
there's still lots of ammunition, lots of reserves to really support the currency in a structural manner.
okay.
So,
Sir, what about,
yeah.
sorry to interrupt, sir, what about the Fed decision in the US in March? Because that was really hinged on inflation going up, which now might be the case, but at the same time, there's also worries that consumer, spending will go down. There might be slowdowns in the economy in Europe and in the US because of this ongoing war. Now, is the 50 basis point rate hike still on the table? Are those 6 to 7 hikes in the year still on the table? And how would this affect what you were saying, the foreign fund flows and our reserves?
Well, Danie, at least the markets have been well prepared. They have anticipated both of these external factors, particularly the more hawkish Fed that we've been hearing. The Fed has done a good job in conditioning the market since June of last year, and they have made updates on their more hawkish stance in the effort to better manage or rein in on elevated inflation. And at the same time, even the geopolitics over the past couple of weeks, the markets have already priced in some of that. And there have been mixed views because, for one, oil prices and other commodities remain elevated because they could still potentially contribute to the relatively elevated inflation, especially in the US and in other global economies. However, the markets have been kind of pricing in also the fact that there may be some less aggressiveness on the part of the Fed in tightening monetary policy in view of this latest geopolitical developments, especially since Russia invaded and started this war with Ukraine, because that could potentially, of course, other than the inflationary impact, it would slow down global economic prospects because of reduced trade activities, and that would slow things down, and some constraints on payments that would also aggravate well, the disruptions in the global supply chains. And hopefully, yeah, that's being priced in. In fact, we were kind of, what's really interesting, towards the tail end of last week, the last 2 days, well, when the invasion of Russia started last February 24, ironically, U.S. stock markets even gained for 2 straight days and posted a new 1 week highs. And we even saw a modest week-on-week gain by the S&P 500 by 0.8%, nearly a percent because of that. So, well, the markets may have already priced in all of those external, well, those external factors, well, including the geopolitical risk involving Russia. So, but of course, the futures are pointing towards another direction. There were already indications of some downward correction again in the U.S. stock market tonight.
Sir Mike,
uh, yeah,
Sir Mike, sorry to interrupt, but apart from the external factors that we have been talking about here, there's also a domestic issue here that we have to take into account, especially when talking about inflation. You have loosening of restrictions. That's going to begin tomorrow. How is that at least going to impact inflation as well?
yeah, that's true, Jess. In fact, the local fixed income markets already partly priced in that fact. Week on week, the yields have gone up by around at least 20 to 30 basis points for both the long end and even most of the short, both the short end and the long term interest rate tenor. So, yeah, because definitely that's kind of inevitable since the country imports almost all of its oil. So that's going to add up to inflation. Though we have to consider also the fact that these are still supply side related inflationary factors. And normally, if you look at from the point of view of monetary policy, well, any tightening won't have an impact to that because of this, no, being supply side in nature, not demand side. So, uh, well, what we're really anticipating now going forward is that would there be second round inflation effects? Would other prices of affected goods and services also go up as a result of higher oil and other commodity imports such as wheat, flour, soybean, among others, the grains that also come from both Russia and Ukraine that may be adversely affected or reduced. So, yeah, that we have to really closely look at those, especially, well, right now we have seen a continuous increase in local fuel pump prices. And maybe at some point, let's see if there there would also be some impact on the prices, say on transport costs or transport fares and other sources of definitely that could also be a consideration. Say
Definitely, Sir Mike.
yeah.
Like what you were
Yes.
mentioning, second round effects here, something we have to be keeping an eye on. We would like, of course, to extend this conversation with you. Unfortunately, we're running out of time. Thank you very much again for your insights this morning. Mike Ricafort, Chief Economist over at RCBC. Thank you, Sir Mike.
Thank you,
Yeah,
sir.
thanks so much, Jess and Dan.
Now, coming right up, the local bourse is not spared from the effects of the conflict between Russia and Ukraine, with shares expected to drop further this week.
More of that and other stories after the break. Stay with us.
And you're still watching Business World Live here on One News. I'm Jess De Los Santos.
And I'm Danie, Laurel.
All right, Dan, markets are percolating, trying to understand which way to go as we begin the trading week in a completely new world and reality. Tell us more.
Okay, as you mentioned, Jess, last Friday was a holiday here commemorating the EDSA revolution. So markets are waking up, as you mentioned, to this horror of war over in Ukraine. And the jitters are being felt for quite a while already. You can see that oil here is at the center of the story. And that is up already, breaching $100 per barrel here. It's trading at $102.28. It seems just like yesterday that during the pandemic, we saw oil at negative prices. So imagine if you had bought that and oil is now 100. Now, Nomura says that India and the Philippines and Thailand will likely stand to lose the most in Asia. We are very dependent on oil, and this will fan our inflation, slow down our growth, and weaken our currencies. In fact, Nomura is saying that every time that the oil has a 10% increase, that will add to 0.4 percentage points to our inflation. And as mentioned already earlier on by Mike Ricafort of RCBC, this will have a negative impact on higher impact on the commodities. You've got Ukraine, a top mineral and agricultural exporter, wheat, natural gas, metals, exacerbating the pandemic prices already. And that was already, dodging the global recovery. And of course, let's take a look at the equity space here. Finally, seeing the light of day over on Friday, but the futures are turning bleak. And if you take a look at how Asia is trading, it's quite a mixed picture here. Some recoveries over in Japan, but when it comes to Singapore, that is still in the red. And let's take a look at the currency space. We were talking quite a lot about the peso earlier on. We are still down by 0.7% year to date amid all of these, foreign currency issues as well as the inflation that will be hitting our peso. Let's open our markets together here. We're actually almost 30 minutes into the trading day. We are considerably doing well compared to the other markets. We're up by 0.9% to 76.22. And this comes, of course, as we posted the smallest net inflow of foreign portfolio investment just in 5 months in January 2022. Interestingly, we posted a net inflow of $14.6 million in January. That was 85% lower than the inflows from foreign investments that we got last year in 2021. And this from AIM economist John Paulo Rivera: brace for the worst, Jess. This ongoing geopolitical tensions, war really between Ukraine and Russia will be hitting our exposure to the hot money inflows, and that might be affected. And finally, I just wanted to take a quick peek at Semirara. This as they have reported their 2021 earnings up by a hefty 8% to 27 pesos per share. Just speaking of commodities, they say that their net income in 2021 was 16.2 billion pesos compared to just 3.29 billion pesos in 2020, that pandemic hit year. Take a look at this. Coal segment contributions growing 535% to 11.4 billion pesos. Average selling prices also up by 229%. So again, our biggest coal producer, Semirara, here jumping by 2 pesos, trading at 27 pesos this morning.
Here are the other headlines we're keeping our eyes on. The Transportation Department said 2 Chinese companies have recently submitted bids for the 74 billion peso bus system project in Davao City. These are the China International Water and Electric Corporation and the China Railway 21st Bureau Group. China International Water and Electric is an engineering company that works in the fields of water, hydropower, new energy, and infrastructure. Meanwhile, China Railway 21st Bureau Group is a company that builds railway complexes, buildings, roads, tunnels, and bridges, among others. The DOTr says it's eyeing to award the contracts for the project's design, construction, and completion in April.
Now, Now, the SEC is warning the public not to invest in 4 entities with unregistered programs that is said to resemble pyramiding and Ponzi schemes. The regulator issued separate advisories against Sky International Trade Corporation, AVZ Ventures Incorporated, Great4 International Marketing Corporation, and SFC Share. The SEC says these firms will be reported to the BIR, which will assess appropriate penalties or taxes that will be imposed.
Now, this from the Philippine Star. The Philippine government says trade relations with Ukraine and even with Russia will continue despite the ongoing conflict between the two nations. Trade Secretary Mon Lopez said there will also be no changes on the pace of the Philippines-Russia Joint Commission on Trade and Economic Cooperation. Lopez added that the impact of the hostilities between Moscow and Kyiv on the Philippine economy would depend on how long the conflict would last. But he also admitted that the invasion has already started to disrupt commodity prices. Ukraine is ranked as the Philippines' 40th trading partner, with trade amounting to $200 million, while Russian trade is around $2 billion.
And speaking of trade, the Philippine Chamber of Commerce is backing the government's plan to begin trade talks with the United States. This comes after Trade Secretary Mon Lopez announced that the government is seeking to begin discussions on fee trade agreement and the renewal of the GSP program with America. Trade privileges under the U.S. GSP program expired last 2020 and have not been renewed. PCCI President George Barcelon also expects that the Philippines' trade relations will further expand once the Regional Comprehensive Economic Partnership is ratified by the Senate.
The business day this Monday, and not just the first business day of the week, but also Danie's first day here back in the newsroom. Welcome back, Dan. Again, today is February 28, 2022. I'm Jess Delos Santos.
So happy to be back, Jess. I'm Danie, Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.